Imagine a single corporation that literally has the power to draft its own laws, conquer nations, and mint its own currency. Right? We often talk about today's tech giants and multinational conglomerates like their massive scale is totally unprecedented. But over 400 years ago, a single corporate entity was born that essentially wrote the absolute blueprint for global business, and honestly, they amassed a level of power that makes modern megacorporations look like small mom-and-pop shops. In this explainer, we're diving directly into the source material to reveal exactly how the English East India Company became the world's first major global corporation and how it shaped the very DNA of modern commerce.
To really wrap your head around their sheer market dominance, you just have to look at the numbers. At its absolute peak, right around the mid-1700s and early 1800s, this single company accounted for half of the world's total trade. Half. Cotton, silk, spices, sugar, tea. I mean, if it was moving across an ocean, there was a 50% chance the East India Company owned it. They weren't just participating in trade, they were dictating global supply chains centuries before modern logistics were even a thing.
And to protect a monopoly that massive, they didn't just hire a few security guards, they built an army, 260,000 soldiers. To put that into perspective, that private corporate military was twice the size of the actual British Army at the time. No way around it, they were a heavily armed sovereign power operating purely for shareholder profit, answering to a boardroom of directors in London rather than to any parliament.
Section 1. The ultimate global startup.
So this whole unprecedented empire kicks off on December 31st, 1600. Incorporated by a royal charter from Queen Elizabeth I, the goal was this incredibly ambitious, highly disruptive venture. They wanted to break the massive Spanish and Portuguese monopoly on the super lucrative spice trade in the East Indies. Now, to pull this off, they needed massive capital, so they utilized an innovative financial structure, the joint stock company. Think of this as kind of the early 17th century equivalent of venture capital. Ocean voyages back then were deadly, long, and unbelievably expensive. By letting multiple shareholders buy and sell stock, they pooled all that massive risk. So if a ship sank, you lost a fraction of your investment, not your entire life savings. This financial engineering is what allowed the company to successfully fund Commander James Lancaster's first major voyage in 1601, which effectively launched their operations and, well, changed global finance forever.
But as you'd expect, early on, this startup faced some incredibly violent pushback. The company encountered intense rivalry, especially from the Dutch in the Spice Islands, what we now call Indonesia. The real tipping point was the brutal Amboina massacre in 1623, where Dutch authorities literally tortured and executed English traders. This was a catastrophic setback, and it actually forced a massive corporate pivot. Realizing they just couldn't immediately compete with the Dutch monopoly over there, the East India Company formally abandoned the Spice Islands and shifted their focus directly to India. There, they zeroed in on textiles and managed to secure vital trading concessions from the incredibly wealthy, powerful Mughal Empire.
Section 2. Pivots and hostile takeovers. Following that pivot into India, their entire strategy shifted. And there's a real visual irony to this era, right? You'd have a British corporate official acting as a colonial ruler, yet completely surrounded by a traditional Indian procession. Because for its first century in India, the company didn't actually conquer. They assimilated into the existing Mughal system. They acted almost like vassals, paying respect to local rulers. And they used this submissive, low-profile position to peacefully build up immense wealth, cultivate these vital trade relationships, and just slowly outmaneuver their European competitors on the subcontinent.
But then things change. As the central Mughal Empire began to decentralize and fracture in the early 1700s, the company switched up their tactics. They engaged in what modern boardrooms would definitely call aggressive mergers and acquisitions. Except, these were military conquests. Through really decisive, bloody victories like the Battle of Plassey in 1757, led by Robert Clive, and the Battle of Buxar in 1764, the company executed hostile takeovers of massive, wealthy regions like Bengal. And these victories didn't just give them trading rights, they won the Diwani, which is the official right to collect taxes and land revenue. Think about that for a second. A private trading company was now collecting sovereign taxes from millions of everyday citizens.
Section 3. A monopoly built on blood.
So what happens when a corporation with a total monopoly is given administrative control over millions of people with absolutely zero regulatory oversight? Well, the human cost is absolutely staggering. The primary obsession of the East India Company was extracting raw materials, things like textiles, silk, spices, and saltpeter, all to satisfy dividend-hungry shareholders back in London. To maximize those returns, they implemented just ruinous levels of land taxation on local agrarian economies, and they refused to offer any relief even when crops failed. These harsh, totally inflexible revenue policies rapidly drained the subcontinent's wealth and directly exacerbated the Great Bengal Famine of 1770. It was a catastrophic event where an estimated 10 million people starved to death, all while the company ruthlessly enforced tax collection just to maintain its profit margins. The company also heavily utilized human exploitation to build its infrastructure and maintain those global supply chains. Starting all the way back in the early 1620s, the East India Company began using enslaved labor. They systematically sourced enslaved people primarily from East Africa, specifically from regions in Madagascar and Mozambique, and transported them across the Indian Ocean to company holdings throughout India and Indonesia. This large-scale corporate transportation of enslaved human beings actually peaked between the 1730s and 1750s. Enslaved individuals were used to build forts, load ships, and support this rapidly expanding network of corporate outposts. It's a grim, sobering reality that entirely underpinned the company's incredibly lucrative logistics network.
Section 4. The Tea and Opium Trade.
As the 18th century rolled on, the highly profitable Indian cotton trade actually began to decline, which prompted the company's next major market disruption, a massive pivot toward East Asia. By this point, tea imported from China had become this massive consumer trend in Britain and its colonies. The company's global reach was immense, but it was also fiercely protected by the British government. In fact, the Tea Act of 1773 allowed the East India Company to sell its massive surplus of Chinese tea directly to the American colonies without paying the standard taxes. This effectively undercut local smugglers and merchants. And that aggressive monopoly strategy, it directly sparked the Boston Tea Party. The American Revolution was, in a lot of ways, a violent protest targeting this specific, unchecked multinational corporation.
But trading with China presented a massive logistical problem for them, a severe trade deficit. Basically, China wanted silver, not British-manufactured goods in exchange for their tea. So to solve this cash flow problem, the East India Company essentially became a state-sponsored drug cartel. Seriously. They began cultivating opium in their Indian territories and illegally exporting it into China just to finance the tea trade. This created a devastating addiction crisis within China. When Chinese authorities finally clamped down and opposed this illegal corporate drug trafficking, it precipitated the Opium Wars. The end result was Chinese defeat and the brutal expansion of British and company trading privileges, literally forcing open ports just to balance a corporate ledger.
Section 5. Bailouts and Breakups.
Ultimately, though, that level of unchecked power is always going to invite intervention. As company officers returned to Britain with unfathomable wealth, they were often dubbed nabobs. They essentially bought political power. I mean, they literally purchased seats in the House of Commons and heavily lobbied to protect their monopoly and dodge any scrutiny. But the British government slowly started to realize that this rogue corporate asset was becoming too big to fail, and frankly, too dangerous to ignore. Over 3 centuries, Parliament systematically stepped in. The Regulating Act of 1773 was the first major step, forcing government oversight onto the company's board of directors and capping dividends, which really signaled the beginning of the end for their absolute independence.
From there, it was a step-by-step bureaucratic dismantling, stripping the corporation of its foundational privileges one by one. First, they lost their commercial monopoly on trade with India in 1813. Then, by 1834, they were stripped of commercial trading altogether, basically transformed into a mere managing agency administering territory for the British government. But the fatal blow came with the Indian Rebellion of 1857. It was a massive uprising against the company's insensitive and exploitative rule. It proved once and for all that a private company just couldn't and absolutely shouldn't govern a subcontinent of millions. Consequently, in 1858, the British government passed an act to fully nationalize the company, permanently taking over its massive armies, its revenue streams, and its vast territories.
So the end didn't actually come with some massive war. It came with a legislative whimper. The East India Stock Dividend Redemption Act of 1873 arranged for a final stock payout to the remaining shareholders. The text read, "On the first day of June, 1874, the powers of the East India Company shall cease, and the said company shall be dissolved." And just like that, on that exact date, the most powerful corporation the world had ever seen was formally dissolved with the simple stroke of a parliamentary pen. They just faded into history as a finalized balance sheet.
Which leaves us with a really critical question to consider. The English East India Company may have been dissolved in 1874 for sure, but they pioneered the joint stock structure, global supply chains, aggressive lobbying, and hostile takeovers. When you look at today's multinational conglomerates, with their staggering wealth,
and their profound influence over global politics, supply networks, and labor forces, do you still see the ghost of the East India Company? It is, without a doubt, the ultimate corporate blueprint, and understanding it is absolutely key to understanding our modern business world.